Yes, so good afternoon, everybody. Welcome to Scope's Global Economy Outlook. We have the title today, Inflation War, Europe's Energy Crisis, Darken the Outlook. So certainly some interesting subjects here. My name is Dierk Brandenburg. I'm Scope's Head of ESG and Credit Research, and I'm joined here today by representatives from Scope's various rating franchises, and that includes today the public sector finance franchise, the corporate and the bank franchise. And we will take you through the sort of main aspects here that we're covering at the moment in the various sectors. Before we start, housekeeping items are the usual ones. So we have a chat function, which you can use to ask questions, which we then hope to pick up during the presentation. So just fire away and I'll have a look on what's coming in. And then the second aspect is that we do have a little apps button at the bottom of your screen where you can also download the material for this presentation, both in terms of the slides, but also research papers we published recently. And in any case, all the papers are available on our websites on scoperatings.com. With that, I will take the first part of the presentation and talk about the general state of the credit markets and what that actually means for credit ratings and our outlook. And then I'll pass it on to the next group of speakers here. So just in terms of the overall credit environment we're in, I think it's no surprise, and anybody who works in markets will have experienced that firsthand, that we are in a very difficult credit environment at the moment. And that is indeed not only sort of a short-term phenomenon, but also if we look back, this is actually one of the worst periods we had for a very long time. We do track those conditions with a financial conditions index. For those not familiar with this concept, essentially we look at a wide variety of interest rates, credit spreads, equity markets data, foreign exchange and commodities prices. We look at them back over the history. We look at where they are relative to historical means, and then we weight them by their respective volatility to construct some overall picture about credit conditions. For the statisticians among the audience, this is called the Z-scores. That is quite a common concept. What we're offering here is some more insight in terms of what actually drives this analysis. The key point to make here is also with respect to previous incidences of such deterioration is that this year's deterioration very much driven by inflation and rates, and actually to a slightly less extent by credit spreads, which typically triggered the previous crises, both in 2020, the COVID crisis, and then also previously the Great Financial Crisis, and then also the Euro credit crisis. So this development played out slightly different in the last 6 months. But then since May, we also have quite a deterioration in credit conditions. So this is credit spreads essentially widening, and that is essentially the whole picture switching from a general fear of inflation and what central banks may or may not do to fear of recession, i.e. selling down credit in anticipation of future defaults. One driver here, and I'm just picking a pretty common example here, is clearly the sentiment. So there's various sentiment indicators out there. Most commonly used, as you're well familiar with, are PMIs. Main point here is the most recent read, particularly in the US and also in the Euro area, again, also very much driven by Germany, is the continuous deterioration, particularly in manufacturing PMIs, but also services, which does suggest that an economic slowdown is definitely happening at this stage as we enter the third quarter. It has actually had a different impact on credit markets in the sense that we've moved, at least for the month of July, more towards a bad news is good news scenario, in the sense that slowing economic growth potentially could lead to lower inflation, less aggressive central bank policies going forward, which fundamentally then again could support credit. So that's an important aspect certainly to watch here. And that's also why we would not take at this stage all these very negative sentiment to actually play out as an actual very bad recession, although clearly that is on the cards. And that is the purpose of today's call, to shed some more light on this. Against this background, I have to highlight that credit ratings in general, and including our own, have remained very resilient in the first half of 2020. And this is here, what you see here is across our corporate, sovereign, and public sector franchise. And point being that the mood is a lot worse than the underlying reality in a lot of credits, and that means particular corporates enjoyed very often still a very strong recovery from the pandemic disturbances in 2021 and 2020, and also our distribution of outlooks, which are very much based on our bottom-up analysis of credits. So there's no top-down sort of outlook we put on our ratings just because the economic outlook in general changes. Our outlooks are also still pretty evenly distributed towards the upside and the downside, although clearly there's a slight uptick here of negative outlooks in recent weeks. One particular aspect about scope relative to other credit rating agencies is that our franchise is still growing. So that means if we record higher levels of, for example, BB credits, then that is not necessarily a result of downgrades, but it also means just our overall portfolio of ratings growing, and then vice versa, our single A portfolio also not declining just because the lower ratings go up. So that means the actual migration is actually still very stable. If we go on the next slide here on the right-hand side, you can see our experience of upgrades and downgrades. So a slight, actually positive bias here in the second quarter, though that is on fairly small number of rating actions. And then as a benchmark, I also included the overall ratings universe in Europe of our main peer group of rating agencies, and again, a pretty stable picture here. So I know a lot of people will find that very hard to reconcile with what's the sentiment in the market. But it is really reflective of this very strong, we could call it a base effect of the economic recovery we've seen going into the year, and which to this point really has provided quite a stable backdrop to a lot of estimates. Clearly, we're at the beginning of the second quarter results season, so these things are always subject to change. But overall, credit quality has held up reasonably well this year. One of the supporting factors is clearly that particular corporate sector has managed its maturity profile quite well. So unlike in previous crises, there's not this sort of immediate wall of maturities that needs to be dealt with. You can see that here, actually with the dark blue bars, you can see that issuance has held up generally in the corporate sector quite well. And you can also see that the maturity profile in terms of the immediate refinancing needs here for the rest of 2022 are fairly limited. What we have seen in response to rising yields is what you expect at this stage is a pretty strong drop off in high yield issuance. And you can extend that argument into pretty much any high risk credit asset class, be it corporate hybrids, leveraged loans, and so forth. And clearly that points towards rising refinancing risks. And while we know that the immediate refinancing needs are pretty low in the corporate sector, we also seen some unanticipated financing needs. Most prominent example is the German utilities like Uniper, who suddenly need very big cash injections. So that's why this has to be taken with a bit of pinch of salt, because as corporate cash flows come under pressure, then there's clearly also a possibility that financing needs go up here. Another factor is that since this month, the ECB is no longer available as a big buyer of particular corporate net issuance, which, because of its purchase programming, coming to an end. the central bank will still reinvest its holdings. So we show this here. This is based on ECB data in terms of what reinvestment possibilities there are. But it's clear that one of the main buyers has, for now at least, disappeared from European credit markets. So on one hand, that has been an advantage in the past because a lot of corporates front-loaded their issuance, but clearly there is now less of a sort of backbid for the market here, which again could put pressure on corporate refinancing. One other aspect, and my colleague Nicholas Hardy from our banks team will comment on that later, is that bank issuance has actually held up very well for given the environment that we're out there. So we've seen good volumes both in covered bonds and in unsecured issuance. And I think that is a sign that we are not at the point where we really have to worry about a sort of full-blown credit crunch, i.e. the financial system sort of putting its own pressure on the economy by not being able to provide financing. But we will explore that further down the line. So overall, I think looking at the picture at this stage, before I hand this over to my colleague Dennis Shen from the public finance team, is I think there is a lot of very, very bad mood music out there and some signs of potential slowdown and also ultimately pressure on credit quality. But so far, at least up to this point, the mood has been a lot worse than the actual reality. And with that, I will hand it over to Dennis, who will talk us through our latest macroeconomic outlook, which we only published last week and which is available here on the download. And with that, Dennis, you want to take it on from here, please?
Yeah, thanks so much, Dirk. And so, as referenced, I'll talk under the purview of two documents. The first is our global economic outlook, and the second is a regional concentration on the Central and Eastern European region, which we published today morning. We cut our forecast logically in terms of the global view to 3.1. That was from 4.5 entering this year, and also for 2023 to 3.6. And importantly, in terms of the skew of risk, the balance of risk to the figures globally, regionally, individual countries, and nation states and the like, that skew of risk as it was entering the year remains firmly skewed to the downside, with a significant likelihood of technical recessions, as defined via 2 consecutive quarters of economic contraction. In terms of which 2 quarters we're talking about, that kind of depends on the country. Countries are in different parts of their cycles and different degrees of softness and the like. In more in the immediate terms, there's certainly that risk in relation to the United States. But nonetheless, so that's over this 2022 to 2023 period. But nonetheless, if we look at this graphic on the bottom right, as compared to 2020, which would be certainly in terms of a personal definition of deep economic recession during the COVID-19 crisis peaks, that even with the haircuts that we've made so far, and it is ongoing, but so far, that technically annual rates of economic growth still remained with a buffer positive, both in 2022 and in 2023. As noted, the corrections are ongoing. And at the stage, at least in the forecast horizon through 2023, we do not anticipate within the horizons so-called global financial crisis per 2008, 2009, even though being cognizant and complacent to the fact that the rate of rate increases, the rate of rate hikes that we've seen over the course of the preceding several weeks, several months, has been fairly unparalleled. So in fact, outstretches the pace of increases in the immediate antecedent of the global financial crisis. And so one does have to go back in economic history to the late 1990s in terms of analogous period for the celerity, for the pace of rate increases. That economic slowdown certainly pertains as well to the euro area. That's on the left-hand graphic, fairly diversified in terms of the member states that are involved in terms of there being weakness. And importantly, in terms of the downside, the adverse risks for said economic outlook, in addition to the common refrain about high inflation, about the ECB tightening rates, and the like, maybe the most significant adverse risk relates to the potential for an energy crisis as Gazprom continues to reduce flows to kind of a drip feed, to arguing about things about turbines, and so not completely transparent in terms of the reasoning, and clearly in terms of then both for the winter of 2022 and 22-23. As well as maybe even more significantly, depending upon where storage levels are for the winter of 2023 to 24. Again, we'll see where things go. Per this EU agreement today, in terms of demand cuts and the like, creates the potential for rationing to be needed to be espoused, even though there's significant uncertainty about the extent of it from households, businesses. And that could present downside for the economic outlook in this right-hand graphic as pertaining to Germany, Italy, could be sufficient under that adverse scenario for negative calendar year economic growth 2023. We've noted about the purchasing manager indices. There's been some resilience, but also dipping under contraction for the euro area and the United States by July, but still just under the 50 line. So in terms of those blue lines, big difference between right now and that COVID-19 2020 period towards the left-hand side of the graphics. But clearly consumer confidence has, in terms of the consumer sector, has been among the hardest hit by this crisis, by the inflation rate tightening crisis, and that's really declined rather precipitously. Retail sales have moderated, although there is a bit of an uptick in June in the United States in the retail sales data on a volume basis, which is not illustrated on this left-hand graphic. The labor markets have been comparatively resilient in terms of parts of the core strains in the economy. We know this. And at the same time, in terms of comparative to the baseline forecasts included on the right-hand graphics, that if in the end, as Dierk was pointing out, that central banks were to need to, so to speak, engineer technical recession or engineer economic softness in order to cool the inflation, that central banks would really tighten into technical recession and continue to need to moderate inflation. Naturally, that would point to the supposition that of the need to potentially create a degree of slack, a degree of spare capacity in economies under that thesis. And if so, then in terms of unemployment rates, there is upside risk in terms of unemployment turning out higher than the forecasts on the right, particularly as it pertains to 2023. Inflation higher for longer. And in terms of the discussion last year about patiently accommodative monetary policy, we're never going to let them live that down in terms of Jerome Powell. In terms of transient inflation and the like, I think that's pretty far out the window at this point. But and in terms of this debate, also entering this year about whether central banks, in terms of their positioning, would be tightening too soon compared to too late. I think that's a foregone conclusion at this point, that central banks are tightening too late, have been behind the curve, and are now struggling to catch up in terms of the inflation rates that we're currently observing. Inflation figures on the bottom left-hand graphic have been revised up. So with each of these, each of the quarterly reviews, quarterly economic reviews of the regional / national central banks, At the same time, even in terms of the latest figures, so the upward revised latest figures, I think it's also fair to state that the balance of risk to those inflation numbers on this left-hand graphic remain to the upside. That inflation turns out to be higher, whether in 2022, 23, 24, than the central banks are currently prognosticating. But with that said, as Dierk was also pointing out earlier in this conference call, that with inflation rates being where they are, above 9% in the US, UK, above 8% in the euro area, that over the passage of time, the balance of force in terms of the impetus towards inflation, with being at such exorbitant, astronomical rates, is naturally to the downside in terms of inflation receding over the passage of time. But in terms of the timetable for when inflation, so to speak, peaks and begins to more noticeably recede, that timetable has been postponed on numerous occasions to this point. Although, and probably in terms of, even though it's likely over the coming quarters, that timetable is likely to differ depending upon which region or country that we're looking at. In the United States, there already are signals of peaking. In the euro area, with this gas crisis and surging gas prices, that creates further inflation upside in the near term. And in the UK, as an example, inflation is not likely to peak below 10%. It's likely to exceed 10% year-on-year monthly prints, and not likely to peak before Q4 of this year, just based upon how the energy market with the price ceilings and how that impacts wholesale gas and electricity prices. And included in this, central banks need to be cautious in terms of the increases in inflation expectations on the right-hand table. That has also been, I think, demonstrated vis-a-vis higher wage growth, especially in the US, UK. This transition from headline inflation to core that central banks need to be attentive to. And talking about central banks, in addition to the commonly known the drivers of why this inflation, so what's going on in terms of the supply chain, labor market, materials, transportation bottlenecks, both attributed to the COVID-19 crisis, as well as attributed to the Russia-Ukraine war. Certainly in terms of the rise in commodity prices, energy prices, agricultural prices, how that's fed through to higher manufacturing output prices, to higher non-oil import prices. Certainly also on the demand side. This is not only a supply thing. On the demand side, that in terms of the significant pickup in economic growth starting in 2020, starting in the spring of 2020 to this point, and how that's resulted in record low levels of unemployment across many countries, creating domestic demand, and how that's resulted in services sector inflation. That's all acknowledged. But in addition, there is the inflation driver coming from the currencies in terms of the strong dollar, the strong greenback, and how that's exported inflation to an extent globally in terms of weakening currencies. So for every other country not named the United States, by and large. And this has resulted in it being recognized by the Bank of England, by the ECB, and whether they will admit it or not, a degree of competitive monetary tightening in terms of, to an extent, beggar thy neighbor types of behavior, included in the backdrop in terms of the 50 basis point rate hike of the ECB Thursday of last week, to support the currency and as a result export inflation elsewhere. And that's resulted in upward revisions to our official rate forecasts across the major constituencies, Japan leaving aside. The tightening in financial conditions has been touched on as far as yields, equity benchmarks. I'll touch momentarily about the yield spreads on the top right, which in terms of the fragmentation, naturally has been ongoing. But with Thursday's announcement of the transmission protection instrument of the ECB, naturally that provides a degree of succor in terms of support in those markets, in the periphery markets, especially as it pertains to Greece in terms of the yield response. Greece, because it was included at all, and despite its non-investment grade credit ratings. And on the bottom right, in terms of currencies, as noted about the strong dollar, how that results in inflation globally, and as a result, monetary tightening globally. And finally, to note that this is happening at an inconvenient moment because, similar to the sovereign debt crisis, piggybacking off of the global financial crisis when central banks started to tighten, in terms of this piggybacking off of the COVID-19 crisis, it's in a moment in which debt levels are much higher. So that's kind of somewhat similar in terms of one crisis causing higher debt loads and then crystallization of risks at a later juncture. And the deficits have not completely corrected from COVID-19, from the 2020, 2021 highs, and debt levels remain materially higher, which didn't really matter much during COVID-19, as with many, at least in many advanced economies, with central banks loosening quantitative easing, significant balance sheet policies. But at the present moment, naturally that reduces the degree of fiscal space inconveniently at a moment in which monetary space is also rather more limited. And so the capacity for central banks and national policymakers to respond if certain economies enter into technical recession, as an example, is comparatively, as a result, more limited in terms of the ability to correct for market failure under such scenarios, which presents the risk of adverse equilibria. And with that, in terms of some of the discussion around sovereign credit ratings and our positioning, we'll leave that for questions later. And similarly, as relates to emerging markets, I will leave that for the moment to continue the conversation.
Thank you, Dennis. Let's move on. I think you highlight very well that both the sheer availability of energy in Europe, but then also certainly the price of that energy globally is a key both factor in assessing inflation and also in defining the risk around our outlook. In the next part of this session, I will hand it over to our corporate team, particularly the energy specialists in our corporate team. So we got Marlin Shoketbayev and Sebastian Sang, who will go down a bit more deeply in what that actually means at the level of individual credits and then the sector level, if indeed availability of gas in particular, and then prices of those inputs play out as some of these stress scenarios suggest. I don't know who will take it from here. Is it Sebastian or Marlin?
I think if you can hear me, then I will take it.
Yeah, we can hear you. Great.
Okay. So then
go ahead, Sebastian.
I had a few technical issues, but the problem seems to be solved. Thanks, Dierk, for the introduction. So my colleague Dennis has already elaborated a little bit on one of the underlying problems of all this uncertainty for the macroeconomic outlook. So, of course, everybody who follows the press knows what one of the major problems is, and that is primarily related to the gas squeeze that we now see in Europe for a number of weeks, or if not months. But that's just the root of a number of problems that we see, because the gas squeeze has, of course, repercussions on a number of other fields, be it electricity prices, be it input material for other industrial production processes, and the likes. That really then results in this big uncertainties that we'll have for the rest of 2022 and surely also for 2023 and maybe even beyond. So when you look at the price developments of the gas price over the past few weeks, which is shown in the upper graph on this slide, then you can clearly see the very delicate price development, which is not only related to the absolute pricing that you see in various markets, which we have depicted here for the major European gas hubs. It's also related to the underlying volatility that is nicely shown in this price graph. This situation is surely not going to ease over the next few weeks. when looking at what the Kremlin or Gazprom is doing on gas deliveries to Europe. So you can clearly see that some markets are better off than others, but the overall picture is basically the same, that the gas prices are definitely causing an issue for major economies, standing at a level which is between 5 times to 10 times higher than what we have seen over the past few years. That's what I initially said is not the only thing. There are also repercussions on, for example, electricity prices that you see on the lower chart, which somehow follow the development of the gas price. As in the main markets, the gas fired power plants are setting the marginal price for the entire electricity system. So with the increased gas prices, then with some time lag, you'll also see the increase of electricity prices, and that will hit the European economies maybe not in 2022, but rather in 2023, because usually the power generators are selling forward their electricity to a large extent. So that means that then, starting next year, a lot of consumers will see the price increases then also on the electricity side. As I said, this situation will continue for some time, and the best evidence was just this week with the developments on the gas flows through the Nord Stream 1 pipeline. Although the operations have resumed and Gazprom again delivered 40% to Europe after this maintenance of the pipeline, just yesterday you were able to see that again volumes will be cut to 20% now of the normal gas flows. So it's very clear that gas flows are being used as some kind of political weapon. Our perception of the whole situation is that a gas or a complete stop of the gas flows is rather unlikely, because if that would happen, then the Kremlin would certainly lose one of its most powerful weapons against the sanctions from Europe. So the best weapon, so to say, is to have very volatile gas flows to Europe, where then you see big uncertainty in the European market continuing. That situation will be maintained from our perspective over the next few months. And that could definitely have some severe repercussions then on the whole corporate sector and other attached sectors. So is there light at the end of the tunnel? Because politicians, companies, consumers are certainly not sleeping and implement certain measures in order to face this delicate position. So what we have already seen over the past few months is a drastic cut of gas consumption in Europe. That looks very great first glance when you see the big reduction numbers year on year shown on the upper graph at the upper end of the screen. But one has to admit that a lot of this gas consumption reduction is related to temperatures, so something that is not controllable, which is still a big uncertainty going forward if European economies can basically maintain this sentiment on reducing gas flows, because overall there is no light at the end of the tunnel, at least not in the short term, because real measures that can truly ease the pain are not at sight. So although, of course, one could diversify the procurement channels away from the piped gas to liquefied gas in regasification terminals for LNG. This is really difficult and delicate in Europe because the existing infrastructure is just not able to use the spare capacities that would be available in the European market in order to supply those economies which are in high need of missing gas supplies, which is Central Europe. LNG is just a solution in the medium to long term. But overall, it needs to be a mix of various measures that could be implemented, which are to be found on the overall consumption side and on the supply side for with alternative procurement channels, which could ease the pain in the medium term. Nevertheless, even if other procurement channels would be found, one thing is quite clear. We are not, or we are unlikely returning to a situation anytime soon, which we had until 2021, where we really had very modest price levels for natural gas. So that will surely hit companies and economies overall. And in the very end, lots of market participants will lose out. So we have taken a deeper look on the German economy, which is the most dependent economy on Russian piped gas. And here we see this delicate picture that all the ambitions that everybody has taken over the past few months have not materialized in maybe above average storage levels, which we can live off, so to say, then in the remaining months. So there needs to be a much higher gas inflow in order to achieve those volumes that we need before we enter the winter heating season. And when you then look at the measures that could be taken, then you see that in the worst case, so in the event risk that gas flows will really be reduced on a continuous basis, then the energy intensive industrials or industrial consumers will face something that I would call a double whammy for the industry. So those industries which are highly energy intense, gas intense, electricity intense, and here we could mention particularly the chemicals industry, the metals and mining industry, but also food processors, they would surely be hit severely by two factors. So one factor is certainly the high price level that those companies need to digest, but the other factor is then also the non-availability of input prices for the production of goods, which will then cause production stops. And in the third step then, this also has repercussions on all the consumers of those produced goods, which will face the supply chain disruptions that could hit the market overall. So in the very end, somebody has to take the burden of this energy price squeeze. And in the very end, it's kind of a vicious circle where everybody has to take some pain. So it's the consumers, it's the utilities, which are somewhere in between, but it's also the sovereigns or the state finances, which have to support. So in various countries, we see different reactions on this price squeeze. Nobody can tell which one is the right path to choose. Dierk initially mentioned that for the time being, everything looks fine on the side of the credit quality of European corporates. But if this situation is going to continue, then it's just a question of time until we not only see a squeeze on the gas supply and the electricity prices. It's then just a question before we see a significant squeeze also on the credit quality of companies that are highly exposed to this situation. For the time being, we at Scope, we have not incorporated this through the bank in a number of negative outlooks or downgrades. So for us, this is still something like an event risk to which we would react if the conditions would become even more severe before we take these rating or negative rating actions. So with that, then maybe over to my colleagues from the financial institutions side.
Thank you, Sebastian. Just one very quick audience question. I think you answered it already. It's about how realistic is it to really rely on LNG as an alternative here? I guess both
medium
today
term,
and then over the medium term. I mean, how do you factor that in? Is that the sort of holy grail here to just bring in more and more of this, or how do we see that?
For today, it's not the holy grail because the infrastructure is not there yet, and we only have these spare capacities in markets which do not have a real squeeze on gas supply. In the medium term, and you now see these big ambitions to build LNG terminals, primarily in those markets which do not have capacities. It's definitely a solution. But that will also then go along with continuously high prices because LNG is not cheap. When the demand for LNG will be significantly higher than what we have seen over the past few years, that which will surely then have an impact on sustainably high prices. And those companies or those consumers which do not have the power to pass on these higher procurement prices, then from whatever channel, they will then have the problem. Then maybe they have the gas, but then they have a problem on the profitability and the overall credit quality.
Yeah, no, thank you. I think that is an important point, actually, if you also link this to our economic outlook, that in the end, there's one specific point about Europe that, it is suffering a really drastic deterioration in its terms of trade, which is basically making people poorer here in Europe. And I think as we highlighted both in our economic outlook, but then also on the corporate bottom-up view, this is quite a big negative here going forward. So with that, I'll move on to the financial sector. I mean, usually the financial sector is the one that causes the problem or amplifies the problem. So with that, I'll put you into the hot seat, Nicholas, and why don't you give us our view on the European financial sector and how we see that those risks playing out in banks' balance sheet.
Thank you, Dierk, and good afternoon. So at the moment, our attention regarding European banks is focused on two important topics. The first one is how banks will be affected by the economic slowdown. And an emerging theme is how rising interest rates are going to impact their creditworthiness negatively or positively. And yes, there are many other relevant topics, but they tend to affect banks individually. For instance, how some banks are managing their direct exposure to Russia or making efforts to exit the country. So it's more a case-by-case analysis on that front. So the baseline macroeconomic scenario is what it is. It's supportive, and many indicators are in positive territories. So As we highlighted already, sentiment about the future has turned more negative. But for the moment, the actual financial performance of the banks and our expectations from a credit standpoint remain sound. And this is what you can see on the screen in terms of rating category distribution and outlook distribution. We continue to see the large European banks and even smaller institutions generally in the A category, and we even have a decent portion in the AA category. Outlooks are generally stable, and as I said, negative or positive outlooks point to bank-specific issues at that stage. So we have, for instance, fundamentally improving or weakening business models in Italy, in Ireland, in Belgium. We have litigation risk in countries like Denmark and geopolitical risk in Australia. So those are the main rating change drivers that we have for the banks in this sample. So we all feel that we are entering a new phase. And where are we now as far as European banks are concerned? So our key message for banks is to say that generally banks are in good shape. And I would like to point to three comforting elements. The first one is about the evolution of non-performing loans. That's the chart A. It shows the constant improvements that banks have made, also thanks to regulatory pressure to do that. So constant and significant efforts to clean balance sheet and reduce the stock of non-performing loans. And we are now at about a third of the level where we used to be a while ago. So it's a very positive development because banks have created room in case of a reversal of the trend. So, and this was a pre-COVID ambition. And what is positive is that the trend has not reversed because of the pandemic. So banks are at the moment in better shape. The second and third element, positive element, is when we look at the lines of defense for banks. So first, pre-provision profits, where are we? And loss absorption capacity out of own funds, so capital basically. And chart B shows that for most banks, there is a reassuring buffer between the actual loss provisions, what we have seen quarter after quarters, and the full potential for loss absorption, which is the yellow sign. So the difference between the blue bar and the yellow sign in the chart B shows the potential for banks to absorb more losses. In terms of capital position also, banks were under sort of pressure to improve their capital position. You may remember the dividend ban during the COVID crisis that really was beneficial in terms of capital position for banks. At the moment, looking on chart C at the distribution that we have, we can see that most banks at least have a buffer of 200 bips and above regulatory requirements. So they have the capacity to absorb single credit events in case of need. Solid buffer, improve quality of balance sheet, but the well-known challenge, remaining challenge for banks is to improve profitability in a low interest rate environment. That was a recurring theme for banks. You can see on chart D the distribution of return on equity. Most of the banks are well below 10%, and this is really a challenge for banks, how they can remunerate cost of capital. So where are we now that interest rates are turning? We now have an interest rate hike in Europe. How this reversal is going to impact banks? So in a nutshell, we consider that this will be broadly positive for banks, but of course, the equation is complex. So what we can see on chart E is how banks have managed the way down during the long period of lower for longer interest rates. So they've managed during that period to limit revenue erosion. There is indeed a nice parallel shift between the interest income and interest expense line, and a limited erosion of net interest revenue. And we expect now that banks will benefit again from the repricing of their balance sheet. It has been effectively done on the way down, and the way up should be beneficial for banks. Their balance sheets are structurally positioned for that positive effect. Still, what is important to remember is that the rationale for the rate hikes is to curb credit demand. So if this policy works, higher rates but lower lending volumes is not going to solve the profitability challenge for banks, at least some of them that are facing structural profitability issues. In any case, this evolution, the repricing of the books should be gradual. And for instance, on the asset side, we expect that banks will continue to anticipate that interest rate will go up and continue to borrow. So the short-term effect on banks should be limited in terms of credit demand. If we continue to look at the other side effect of this repricing, on the liability side, banks manage excess liquidity. We can see this positive development during the COVID crisis with nicely evolving loan-to-deposit ratios going down, high regulatory liquidity coverage ratio, partly thanks to TLTRO, and clients accumulating precautionary savings. That was a positive development in 2020. It continued in 2021. It may become an issue if, for banks now, credit demand is effectively contracting. So, as Dierk mentioned earlier, we are not yet there. On both sides of the balance sheet, there is no credit crunch for the moment. But of course, for some banks, refinancing is more costly. And also, we have seen in some countries, regulatory authorities asking for a repricing of regulated savings, for instance. And that could move more rapidly than banks can achieve on the asset side. That's something to monitor. So the point is not to be excessively negative. There are other issues like operating costs going up because of wage inflation, for instance, and of course, because of the timing of financial condition, unexpected rise of cost of risk for banks. But all in all, the net benefit of balance sheet repricing, we believe that it will be positive for banks. And we have seen some positive development already as part of the Q2 earnings season. If we go north, some Norwegian banks really posted a very interesting positive development there and provided guidance on interest revenues that show how banks can benefit from this interest rate hike. So the prospects are uncertain, and this is also what the equity market reflects with the chart we have there, chart F, showing how price to book evolved for banks. Some hopes at the end of 2021, and now we are back to very low level at around 60% price to book value. So it really reflects that despite the expectation that interest rates going up will be beneficial for banks, markets are still really questioning the long-term viability of banks' business model and their ability also to deliver bottom line in the coming quarters. It's maybe it's a different perspective from us, credit perspective. Again, to conclude and summarize, baseline economic scenarios are still supportive, balance sheets are cleaner, and interest rates should be broadly positive. So things to keep in mind also, we believe that this evolution could lead to a more apparent diverging credit quality among banks in the coming quarters. But again, from a position of strength, and that should be gradual.
Thank you, Nicholas. Maybe just one follow-up question here. Banks in a high inflation environment, I guess you outlined the pros and cons here. I mean, how do you see that the aspect of loan growth here playing out for banks? Because clearly, with nominal asset values or nominal GDP rising, generally a good thing for banks, and I guess exactly the opposite scenario, as you pointed out, to the deflationary times banks have been through. Do you expect that banks will be able to generate loan growth here in this environment, or is just the recessionary fear, will that just lead to more stagnation? What are we assuming here?
Yeah, I think the potentially contracting loan book topic is more for 2023, because as long as we all anticipate that interest rate will continue to go up, there is an incentive to continue to borrow at a favorable rate. So this is why I think we will likely continue to have quite a widening gap between banks' performance and the sentiment fading about the macroeconomic prospect. So, and cost of risk, there is always also a time lag for NPL formation. So for the rest of the year, it's likely that banks will continue to have decent earnings and supported by a decent loan growth until the end of the year.
Okay, great. Got 2 minutes left for questions here. So I'll just hand one more question to Dennis. Just in terms of the scenario that Sebastian was outlining around sort of permanently higher energy costs. I mean, what is it that we're assuming in our outlook in terms of level and trajectory of energy prices? I mean, that's a key driver of headline inflation, I guess, key driver of real household incomes and consumption. How do we look at that, Dennis? I know you produced some scenarios on Italy and Germany that see a pretty stark reduction in GDP here potentially. But I mean, overall, what's your take on energy prices?
I mean, in part, I learned a long time ago in terms of predicting energy prices or predicting crude oil prices that it's not a particularly good idea. But in terms of baseline assumptions would be presumably the kind of roughly where, as far as Brent crude and the like, that they remained volatile. In fact, recently there's been a correction in prices. By and large, if we look over a multi-week basis, and naturally acknowledging the significant increase in terms of the natural gas prices, including in terms of around this further cut in the Nord Stream 1 pipeline flows to, as Sebastian made a rightful reference to 20% from 40%. And so in terms of adverse scenarios, both in terms of the impact from inflation, as far as a gas crisis and the need for demand cuts, maybe a la the 15% that is being talked about and being agreed. Although again, the execution of that, I think there's uncertainty in that in terms of the exception clauses and the like, and the want to consider the degree of storage on individual nation state basis and how that translates. But in terms of that over this coming heating season and the winter season, both as far as the inflationary effect, but as well in terms of from a demand standpoint, the need to cut energy use. Naturally, that's informing the adverse scenario downside risk. Now, if we have a scenario in which WTI crude, which early on after the further invasion of the Ukraine went to levels above 120, 130, that kind of a level, in which it surpasses that, and there's a further significant appreciation in prices. Naturally, from an inflation standpoint and purchasing power standpoint, that presents further downside. But we're working with what we have, which is a scenario acknowledging the significant uncertainty of energy prices, sort of where they've been in terms of the recent past.
Thank you. With that, we reached the end of this call. I have one question here. I just want to make sure that actually people understand what Scope is doing. So I think a very good question is, what should private investors actually do with their assets? As a rating agency, we can't really, we're actually not authorized to answer questions like that. But I would highlight that Scope does rate a lot of funds. And we regularly host webinars for funds as well. And so any type of these questions are best directed to our sister franchise that deals with investment funds. So with that, I have to first of all thank you, the audience, staying with us for an hour this afternoon. And then obviously I thank my co-presenters here today. And I'm looking forward to our next call, which we will no doubt announce in due course. Thank you very much, everybody.